And we are live on Oz Property Investors, the property rulebook or property playbook, not the rulebook. Yeah, I got confused with that.
Great
How you going, Joe?
Australian property rulebook. That's what it'll be
Oz
today.
Property Investors.
Oz Property Investor Rulebook. I'm great, Jeff. How are you, mate?
I'm feeling, yeah, I don't know, I feel tired sort of leading up to, and I get this last hour, I get a burst of energy. So get excited to get on, talk to the crew, and I've been preparing for this session. So I'm excited to unpack just some, I didn't bring a whole bunch of data because I didn't want to send people to sleep the day before we're going to celebrate, or hopefully we'll celebrate the day before we have a day off to have a barbecue and do that good stuff, and not for everybody, but so I'm excited though. Let's get straight in. Let's do a quote of the week before we so what is your quote, Mr. Tucker?
So I've been reading up a lot about Jeff Bezos because he's a bit of an interesting guy. He's created a very interesting business out of not a lot and turned it into an amazing platform. But he's actually a lot smarter than, you just kind of see him up there being all bald and, running.
His name's Jeff. What do you expect, Joe? Of course.
He's got an extra F. Maybe that's the power. But no, anyway, I've been reading some biographies on him. Anyway, his one is, what I liked out of that was frugality drives innovation, just like any other constraint does. One of the only ways to get out of a tight box is to invent your way out. And I really like that. Frugality drives innovation. And that was what got me into my first property. I could have, just bought a buy and hold set and forget property with the $60,000 I had. But no, I didn't. Instead, I figured out a way to get a guarantor loan and use that, renovate the property for the $60,000 and then withdraw the equity and then continue building the portfolio. But, frugality drives innovation. You've just got to keep that mindset no matter where you go. He says that to this day. You have to be frugal and you have to think like you're struggling, because that's where you get most creative. So that's what I like. I don't know.
Yeah.
Anything to say on that one?
Similar to that bloke on Shark Tank, the African American guy who Damon John. He's got a book called something like Act Broke or something, or which he kind of like, he's a multi-millionaire, like 100 millionaire. So similar. It's interesting. Yeah, I kind of like that. But we could debate
yours,
on
mate?
that.
What's your quote of the week?
My quote is not as profound and not. I like to try and match. So I love learning, and so my quote is, never lose your sense of wonder. And I got that as from being from Anonymous, because I was thinking about what I wanted to present for this session and the rule book, what my rule book looks like. So I thought, well, that kind of matches. It's kind of like a Dr. Seuss quote. It's like the one, I don't know what Dr. Seuss quote, but yeah, that's what I had.
Green eggs and ham, or
which there's that whole quote? The places you'll go, like something. Yeah, that's a cool book. It's a fun book.
I love it. Well, to give people a bit of an introduction of what we're going to be chatting about today, it is just Jeff and I. We have no guests today because we thought, last Australia Day, it was the same thing where it was Jeff and I riffing on, I don't know what we're riffing on, but it was something I'm sure.
It was a data deep dive, Moreton
Bay data deep dive. There you go. Since that data deep dive, Moreton Bay has done very well. We are going to cover off our playbook, some of the rules and things to think about, because I think what people do is they just kind of dive headfirst into a suburb. They're like, we'll discuss this, but like, I want to buy with, this property I want to buy in this suburb. But does it fit the brief? Like, have you done all of the things that you need to at the beginning? So they try and find this diamond in the rough and try and find this gem. But you need to have rules that allow you to get to that place initially. So it's the way I like to think about it is it's like reductionist. You remove all of the stuff off your plate, so then you're only left with the really good gems that you should be spending your time with. Otherwise, you're just going to spend hours and hours and hours and get frustrated and end up, not buying or making a poor decision. I don't know. What are your thoughts?
If you end up sort of spending too long because you don't have a clear and succinct kind of playbook, then you may end up just sort of through frustration committing to something that maybe you should not have committed to.
Yeah. What would be your take on this session, Jeff?
Yeah, I think you summed it up quite nicely. So this is not going to be absolutely every rule book, because otherwise we'd have a 10-hour session. We'd have an absolute, it would have, yeah, it'd be longer than War and Peace. So this is kind of some of the key things that I was sort of thinking about that I wish that I'd sort of thought a little bit about to stop me from just spinning my wheels and doing research on realestate.com, because I was like, oh, what if I make a mistake? What are those? And you are probably going to make a mistake. So yeah, spoiler alert, you probably will make a couple of mistakes, but hopefully it's not too I suppose critical that you make a horrendous mistake that you can't recover from. But hopefully we can sort of share some of the wisdom and insights that we've had and add value to you on Wednesday night.
Yeah, well, that's one of the things. Again, another Jeff Bezos quote is double the number of experiments you do per year, and you're going to double your inventiveness. So, if you can kind of keep the reps going, and you're trying and failing and trying and failing and trying and failing, or you can just learn from other people's mistakes that are out there as well.
I'd probably say try and learn from other people's mistakes with that with property, given you're going to be committing
hundreds
to
of thousands of dollars.
But yeah, as much as you can. But
okay.
What are we going to do? Heaps of comments. So for your comments and questions, there's going to be Q&A at the end. So we are here to help as best we can. We may not get to all these questions, but shall we throw to our sponsor, and then I'll do an intro as to who we are.
Yeah, and what I was going to say, maybe you don't want this, Jeff, but I kind of want it. I want this to be a little bit more interactive from the audience. So I want to jump. If anyone has any questions about any of the situations that we cover on and touch on, throw in some comments and let us know your thoughts, and we'll bring the questions up. So make it a bit more interactive.
Let's get the disclaimer out there, Joe, please. Well, not now, but yeah, we'll get it out when we need to.
Yeah, hang on. Not financial advice. Anything that you do on this session is not financial advice. You should seek independent financial advice and read that. Thank you. The amazing thing with commercial property investing is that in most cases, it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yields, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia. And not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
Here we go. And I still got the disclaimer up. Good old Joe. So speaking of interactivity, so I should introduce. Do people know who we are? Should we introduce ourselves, Joe? Is that a bit kind of...
Yeah. Okay. You introduce me, I'll introduce you.
We didn't talk about this before. But okay, so Joe is an accomplished professional with 13 years sales, probably 15 years now, research and negotiation experience, property and legal tech. So you were the head of sales at one of Australia's largest, or one of Australia's largest. I don't know. Is there already?
Well, it wasn't the largest when I started, but it was when I left.
After you helped them to grow, and then you left, you carried the torch, you did a relay. So, but you have got a multi-million-dollar property portfolio. You've sort of done a lot of training, done the reps. You've done. I think you and I've been going to seminars for. I've been going since at least 2011. So I'm going to say at least 12 plus years. So we met in 2018, but I think also you're also the co-founder of one of Australia's largest Ozprop, and one of the fastest growing, I don't know how to define that, but buyers agencies, Prop Principles. So Joe, I think I mumbled a bit through that.
Oh,
Well
you
done.
definitely, yeah, you definitely did, but you didn't miss anything, Jef, and that's the most important thing. Great introduction. But who is Jef Miles? Jef Miles is the man that you see in front of you. One F. He doesn't need two Fs. He only gives one F. So Jef Miles has his own multi-million-dollar property portfolio, but he is a man that has been previously a mortgage broker, helping settle over $10 million in a year. He has been involved with renovations, developments, and been in the financial services space for over 10 plus years. And he helped co-found Oz Property Investors, one of the largest property investment groups that you are on right now, Oz Property Investors. This is where we created it about 3 years ago, where we wanted to share how we grew our wealth through property and everything that we've learned completely free, and bring on experts and like-minded people, and we just chat and talk to them about what they've done, how they do it, and how they've built their own portfolio. So hopefully this adds some value to you guys.
I'm pretty sure it will. But yeah, thanks, Joe. Mate, that was much more succinct and very, I loved it. So I don't know whether to do market insights, because we've got a couple of questions already. We've got one question.
Well, we've got one thing I wanted to chat about was inflation. What are your thoughts, young Jef? Inflation has gone from 7.3 to 7.8, and everyone thought it was going down, but it's very much not.
Well, I mean, yeah, interesting you say everyone thought it was going down. You don't really look at 1 month. You got to look at, like, the US, I believe, certainly looks like they're trailing off in terms of their inflation. Australia, I was optimistic that maybe we were, but until you've got some sort of trend, and I think a trend has to be 3 months. So I think it'll bounce around. So that was December's numbers, I believe. The thing with December is you throw Christmas in there, so people would have been going out and blame Xmas, of course. That's exactly what I'm going to do. So, I mean, yeah. What are your thoughts, Joe? Because, and the other thing, I suppose, Joe and I were talking about this before, and I will throw to Joe because he's got many insightful thoughts and probably a few more than me. But there's a bit of a disconnect, because people are still like, oh yeah, how you going? I'm going to go to the shops and pick up my Prada, or go to Aldi and buy a few more, buy a couple more steaks, or a couple more Impossible burgers, all that sort of stuff. And of course that's adding the whole holidaying as well, because we had sort of the COVID situation happen. But then when they go to buy a property, they're like, crap, a couple of months, 12 months ago, I could borrow $1 million. Now I can only borrow $700,000 or $800,000, and it's going to cost me a lot more for those repayments. So there's a bit of a disconnect there between the sort of the spending versus sort of property. So that's kind of those are my thoughts, Joe. What do you think?
Yeah. Well, I mean, the way I look at inflation is it's actually a knife that cuts both ways. I've said this before, and what happens is, being a property investor, inflation is a good thing for you. Like, it's not necessarily the worst thing that happens for you. So the way I like to think about it is, what happens? Everyone knows. I mean, pop it in the comments. What happens when you stuff $100 under your mattress, right? This is what happens. This is what people do. Like, they're like, oh, I don't want to spend any money. I'm going to put my money under the mattress, and that's where it's going to stay forever. It gets eaten away by inflation. So when you get a property, you're not, we need inflation in properties. One of the comments. We buy property and we buy debt at today's dollars. So let's say we stick $100 note under our bed right now. In a year's time, based on that current 7.8 inflation rate, we would have $92.20. So when we get a mortgage on a property, that debt number doesn't change, but it gets eaten away by inflation. So that, let's say 10 years, when we have $400,000, that $400,000 is not going to be worth the same $400,000, but it's only going to be at that amount.
Yeah.
I don't know if I've explained that well enough. It's kind of getting a mortgage and debt is like stuffing that debt and mortgage under your mattress.
The only thing I'd say with that is that the other consideration is, if the value of property also decreases, then you're not necessarily, you may not be gaining as much. So we've seen, and I'm going to bring up the stats of the 2022 the end of December core logic report, and we see across most markets, and they're all medians, and it's across the city. So you could say, of course, there's sort of Braden's poll. So not every market, not every property's gone down, but you sort of it can impact. Yeah, it creates rent, increase the wage. I think that's probably Hayden. It's the sort of stuff he says to me in private chat. Yeah, it is Hayden. So the only problem is if your debt sort of your debt over time will be inflated away. But if they have to increase interest rates too much, then that also can impact property prices. So it's an interesting kind of play.
Yeah, definitely. And I don't think inflation and high interest rates are good for property in the short term, definitely. But in the long term, I have a feeling that if you bought a $400,000 property or a $500,000 property in 10 years' time, it's going to be worth far more than it is right now.
Hopefully. Fingers crossed.
And there it goes right there. Short-term pain for long-term wealth and income building. There was actually a chart. Now we're talking about Hayden again. And he actually posted something on his Facebook just before. So if you don't know who Hayden West is, have we done an episode with Hayden yet?
No, but we can probably get him on. I mean,
maybe ask him right now. Hayden, can you get you on? What I wanted to just share real quick was dwelling. Just share my screen. Sorry, this is live, folks. By the way,
I've prepared so much content and.
Oh, have you? Dwelling prices since April 2022. So as you're going to bring up, Jef, the market has shifted a little bit. There are price changes. But what you can see here is the top end of the market has been affected the most. The middle of the market hasn't been hit as hard. And the bottom end of the market hasn't been hit as hard as well. It's actually in the green. So it's kind of interesting when people just talk about one market. There's no one market. There's different property types within that, and some of them are going up and some of them are
going down. You can see your inboxes
down.
there as well, Joe, on the right. That's all right, though. I can't see the messages, but I can see who they
are. No, that's yeah. So that's an interesting key takeaway. Like what type of cycle are you, what type of market are you buying in, and is it getting affected the most? What you tend to see is the top end of the market leads the property cycle as well, and gets the most benefit from it too. So not to say that buying, high-end stuff isn't the worst, the best idea or the worst idea.
That's a Simpsons quote. Probably hate it. That's probably
we have
Brendan.
To speak up.
Yeah, it's a Simpson. Yeah, you've seen on this. I think that's
It's a quote.
Anyway,
but,
so before we get into the number one, I want to. This was a cracking question. So you said we're going to make it interactive. So if you're going to say that, we need to deliver. So what's his? I'm just trying to see who this was. I didn't pick up the. It was a great question. How long do you guys normally wait before cashing out equity on a property for your next purchase? What do you do, Joe? Normally.
Well, generally, I just do it whenever I need to buy another property. So ideally ASAP. As soon as you do a renovation, like if you're doing a renovation or a value add and you know that the property price has gone above an amount that you can leverage and pull money out of it, do it straight away. If you need it, do it. That's my view on it. Jef, you're an ex-broker, right? You would have dealt with this situation. Is there a time that you have to wait, or how does it kind of work?
Well, usually you're probably going to need to wait at least, I'd say generally 3 months, because particularly if you've done a reno, because they may not necessarily value that straight away, as in you may not, I mean, you sometimes can, but look, you can go and get a valuation sort of as soon as you've done the reno, but there's no guarantee that the bank will take that into consideration. Obviously speak to your accountant and broker and all those sort of good people, but my thoughts is that you should, if a bank is offering you money, as long as it all comes down to your tolerance level as well. Because if you're not comfortable, then you probably shouldn't necessarily take it. So you shouldn't be leveraging that makes you sort of keeps you awake at night for a start. But the hardest time to get money is when you actually want it. So if you can actually get to a stage where you've got cash there, sit it in your offset and do all that sort of good stuff. But access it whenever because then that way, when there is an opportunity come up, because you'll find a property tomorrow and you're like, crap, now I have to go and try and organize the money to be able to buy that property. Whereas if you've got it in the offset, you can just buy the thing if you want. If you make an offer, if you want.
Yeah.
So I don't know if that answers the question, but I hope it does. So
Yeah, and this person, someone popped in here.
mm,
3 months if you bought well would
yep.
be a minimum. Most of the time, 6 months, given enough time to get a decent comparable sales flow through for the valuation. Because the challenge is, if you haven't added any value to the property, the market has already determined what the price of that property is, and they're going to say it's
Mhm.
at 500,000. No, I bought it under market value, $50,000 less. They're like, but you bought it, and you're the market, so the market paid $500,000, not $550,000. So you're going to have to wait for those cycles to come through.
Yep.
Great question.
Keep the questions coming through. We'll get to those, but let's should we go into number one, which my number one rule book. I'm going to bring it up on the
Number
screen.
one rule: start with the budget.
Start with your budget and then the location. So what the heck do I mean by this? Because people probably, I did even one last night because somebody's like, oh, I want to, which location should I buy? What location should I buy? And like they did have a budget, so they'd done a little bit of research, but some people will, I even see some people say, oh, I want to go and buy in, I don't know, they want to go and buy in Bondi, they want to go and buy in Byron Bay, or and then the first question is, well, what is your budget? And then the budget comes out, it's like 600,000 or 700,000. And it's like, okay, if you're buying in Bondi for 600,000 or Byron, I mean, I don't know, you could probably buy a couple of eggs at that price of Byron, because it's just absolutely escalated. But I suppose my point is, people try and sort of they try and fit where they want to buy into their budget, rather than fitting their budget into where they should be looking to buy. And I sort of, and then people sort of get so married to a location, and they sort of say, oh, look, even somewhere like maybe Penrith, if somebody had a 400K budget, you could buy in Penrith for $400,000. And I speak about that market because I know it somewhat well. And I know there's a lot of sort of off the plan units that have been constructed, which you could pick up for probably 400, 450, 500. But the problem is that the optimum use of your money? I would say probably not. And and that's why my playbook is to figure out, well, what is my budget first? Before I don't even bother looking at, okay, am I going to buy in? Of course, once I've determined what my budget is, if I know my budget's 600,000, then I start to consider where I can sort of pick where's likely to perform sort of over the next sort of 3 to 5 to X amount of years. So that's my sort of playbook. And
I think that's super, super important, because at the end of the day, we're just capital allocators. As property investors, we are trying to identify the capital that we have on hand, and how can we allocate it to the best place that's going to get us the best return for our risk tolerance, how much money we have, and what type of outcome we want. I completely agree. I see a lot of people, and this is how you get so frustrated as well, is, you live locally, you live in Penrith, for instance, and you're like, oh, this place is amazing. I know it so well. I know this market incredibly well. $500,000, $400,000. You're not best served to buy a property, a dud asset, like a not great property that you can't add value to, that you can't add anything to at that price. So I think if you start with your budget in mind, you can then actually narrow down. So there's 15,000 suburbs in Australia. If you have a budget and you went to your mortgage broker, I mean, step one, go to your mortgage broker, have a chat with them. What can I borrow? How much can I afford? You will automatically cut down, like you'll get, I mean, it's still a lot, 2,000 or 3,000 suburbs, if you can say, I want to buy between 400 to 500. I don't know about those numbers, but you would definitely cut it down a lot further than you would imagine.
Well, it's actually the best way to. Is there a platform? Because I was trying to do this last night, Joe, because I couldn't do it in real estate. Is Suburb Finder or Suburb Trends? Is that you can filter on your budget, can't you? You can punch in a whole bunch of metrics.
Yeah. You filter it out by the purchase price of what you want to do, but always just kind of give it a bit of leeway as well, so you can. Yeah. I guess one of the other points is, don't buy too far above the median price. That's one thing to be aware of as well. And also, don't think that the median is the be all and end all, but just try not to buy in the upper end of that limit. So if you go to a location and the median house price is 500, I wouldn't be going into that market thinking to buy a $700,000 property. I would go to a market that may be priced at 900,000 or 800,000 and be buying below the median price, because then I've got room to move. I've then got $200,000 that I can flow up to if I have the right type of property and it's helping me out. Now, the problem with medians is if you've got a location and it's got beachside suburb loveliness over here, and then on the other side of the tracks, there's a heap of, housing commission, those type of things. It all kind of factors together and then merges. Says the median house price is 700,000, but no, it's 400,000 on this side and $1.2 million on this side, and it just kind of works out to be 700,000. So people make the mistake of buying, paying $50,000 more in the $400,000 suburb because they think they're getting a good deal. Just be wary of that as well.
If you end up sort of getting so married to a suburb and you just say, I have to buy in this suburb, you can, if you've got a $400,000 or $500,000 budget, and you may end up sort of compromising and buying on something like a main road or a flood zone, a bushfire area, a T section, sort of issues of easements, or those potentially, if you're buying sort of properties that, if you try and fit a budget into an area that's way below, and I wanted to counter my own sort of point, because I saw a post a couple of weeks ago and I thought it was interesting because somebody put up a post and threw some, and they said all houses in the same suburb will largely perform exactly the same. And they sort of said being closer to civic amenities or infrastructure or in better A-grade streets will not improve capital growth. And I thought, oh, that's interesting. And they actually presented some graphs in that post. And I said, and the graphs sort of look like, I was going to bring it up, but I just couldn't figure out how to do it. But they sort of said that it's that buying an asset that was slightly lower was inferior in a B or C or D grade area of the suburb, still actually performed 7.2% versus a better part of the suburb, which was 6.9%. And I sort of I crunched the numbers on that because I thought, well, okay, yeah, fair enough. But if you're buying for, let's just say the median is 900,000, if you buy one for say 4 or 5, let's say 600, and then you have one that's in a nice location and is 700,000. I wanted to see, well, how much difference did that slightly sort of, how much difference did it make in terms? So I've got a compounding sort of. I'm going to bring it up. We're going to do an exercise.
Are we going to do the math? Okay.
Yeah, and because I wanted to check it out, because originally I did it with a 4 versus 800,000. I was like, that's not really fair, because of course the 800,000. So let's bring it up. So here we've got, I brought this up. So to throw my numbers in here, let's say we bought a 700K property, so in an inferior part of the suburb, and this is a bit off the cuff here. And let's just say it performs at 7.2%, which is what the person said. And if you look here, I actually need to reset this. I'll start at this again. Yeah, start it again. So initial contribution, and we'll get on to your first point, Joe. So I just wanted to show this to illustrate how, let's say, rate of return, and this is over 20 years, I'm going to do this as well. Rate of return and annually over 20 years. I think that was what it was from, 20 years. So we see that comes out. So that one's grown at 2.1. That's grown 2.11 million when it's 7.2. So if we throw an 800K asset, and it performs at 6.9%. That one's 2. So it hasn't actually done that much more. So I've sort of, but that actually just proved that disproved my point.
If you do it over 30 years, you'll see there will be a point where the higher return will overlap over the top of it.
Yeah. So I wanted to say, well, potentially that's an argument, but I would say though is once your asset in a lower performing area, well, let's just say there's a power lines or something. Because the reason that 700K property is going up in value is because it's more affordable. So once it even gets close to that 800K property in a more desirable location, people will sort of start to say, do I really want to keep paying more money for that place that's in a compromised area? So that was the flaw that I found with that. But anyway, so my point is focus on the budget rather than the location. Is it?
Someone's commented here. That's a terrible illustration.
It was actually, the numbers I did were better for me. So your first point, Joe, on to you.
Have you got the banner for
I
that?
do.
Oh, look at that. Land appreciates, building depreciates. Um, Really, it's as simple as that, right? I think a lot of people get too excited, and maybe this is they fall for the pretty. And one thing that I learned from Todd Sloan of Pizza and Property was pretty isn't profit. When you buy a property, you're buying a property that has land with it, and land is the appreciating asset. Land is the thing that is growing in value, and buildings depreciate over time. These properties get lower and lower in value. So I think it's 40 years when they fully depreciated out. So when you're thinking about investing, the things that people should be considering are buying with as much land content as possible. How can you buy how can you own as much land as possible? Because the house on there is not going to be as valuable in 20 years' time. The true value is going to be in the land.
Yeah.
And also, yeah.
Can I redeem myself with an illustration, Joe? I think I'm stuffed up.
Go on
No.
then, mate.
So to illustrate that, one of the properties that I have, we got the valuation, the land valuation today, and it was 542, and I reckon it would probably sell, I'd say 800 roughly. So you sort of say the land component is, so if you do that, so the dwelling on it's probably worth about, I don't know, they're estimating it will be worth about 240. So it's the land is more than double the price of the dwelling on it. So the dwelling is literally just being depreciated over time. Just to highlight that.
So yeah, well, one of the questions that's going to come up is, well, I own a townhouse in Sydney, like. That's way better than a house on 1,000 square meters in Bundaberg. Like, what are you talking about here? Land is not. How do you kind of talk to that, Jef? What would you say to that?
I just say Sydney is king. That's all I say. No, because of course there's supply and demand that plays into that, of course. So it's not as simple as saying, as of any of these, it's even like start with the budget and then location. It's not as simple as that. Of course, there's a lot more to it than that. So if you say, it's not really, it's an apples and oranges comparison, because up in Bundaberg, I haven't actually been to Bundaberg. You may have been up there, but there's probably a lot more land you can potentially subdivide. Whereas in Sydney, depending on where in Sydney you are, there's pockets of greenfield sort of parts. But if you're right in sort of the inner pockets of Sydney, you can't really, you can only build up. So that's the land being more valuable.
Yeah, exactly. So if you own, 500 square meters of 300 square meters of Sydney land, it's going to be more valuable than 1,000 square meters of Bundaberg land. So although it is a townhouse and you can't subdivide it, split it up and cut it into anything, it's still a more valuable asset because the land content of what you're owning on that land is way better than, Bundaberg, for instance. Yeah.
I feel a bit sad that we use Sydney, because everybody thinks that we're absolutely Sydney kind of. We love Sydney. And I don't know. To me, I'd say I grew up here and I love the city, but to me, if it doesn't make sense from an investment perspective, then I'll happily put money elsewhere.
Yeah, and here's a good little statement here. Scarcity drives land prices up. If there's not enough, if more people want these, townhouses in Sydney, then it's going to drive them. It's going to drive the values up. People want to live, there's all the reasons why you want to live in Sydney. But what if you can go to an area that has potential for growth that is going to give you a half decent land size? Another point to recognize as well is all land is not created equal too. So talking about rules, like you have to have some rules in your property investing when you're going ahead and selecting properties to buy. So a number of my rules are no bushfire, no flood, no easements, no encumbrances on the title, and no covenants. That's just the blanket rule. Now, there is flexibility on the easement side of things, because if there's an easement on the back of the block, it can still be split in certain parts of, depending on where it is and what it's all looking like. Speak to your town planner and developer and all of that stuff. But what I'm saying is, I'm going to use South Australia because it's an easier example. You can buy a property at 590 square meters for $500,000. If you bought a property for 601 square meters or 600 square meters, you'll probably pay 550. So there's a massive difference between those extra couple of meters, because you can actually add value to that property by subdividing it and splitting it down the middle, as long as you've got the right frontages and all of that stuff. Not financial advice, yada yada. But if you can, like, the land value is very important. Land is what's growing. But if you can then tie that in with a good zoning location, then you're good to go. But I think it would be worthwhile to chat to off the plan and house and land packages, because this is how people sell it as well. You know, they start to try and push off the plan apartments and house and land packages. But again, the fundamental drivers still need to be there.
Are you getting the soapbox out, Joe? Are you going to stand on something again? Because I know how much you love off the plan and house and land packages.
Well, I keep, like, I feel like I beat the don't buy off the plan drum so much, but I constantly see group comments where people are like, oh, I'm thinking about buying this house and land package. Why do you guys think it's such a bad idea? So number one, there are large commissions and kickbacks built into the sales price. So if you buy a property and it's got a builder's like not a builder's margin, but a developer a sales agent, right? Someone to sell it. If they're making $40,000 just on this deal alone, and then the sales agent's getting paid his commission as well, that means there's $40,000 that's in this deal that you're paying for in the inflated purchase price. So watch out for that. It means that you're the one paying for it. Someone has to be paying for it, and it is unfortunately going to be you, the buyer. And if you are going down this route, always make sure that the valuations are going to stack up as well.
Yeah, that's often, it is a challenge. Like sometimes they stack up, like they don't always not. It's probably more of an issue in a sideways or a down market. So I think now people who bought off the plan or house and land in 2020 or 2021, I'd be a little nervous, because when they'll probably be starting to complete sort of around this year, and you sort of start to say, well, what are the comparables that if somebody's sort of paid $1 million and there's now sort of people that are trying to sell these, because it's harder to get finance. So if people can't access that $1 million, a developer's going to say they've got the last residual stock and they'll just sell it to get rid of it at $900K. And next minute, the comparable sale to your $1 million property is $900,000. So potentially valuation issues can come into it.
Yeah. Another downside is in these locations that developers have, usually it's a big green field. There's, 500 properties that can come on the market. The developer actually controls the market a little bit by only releasing a few plots of properties at a time, so they don't flood the market and then lose all of their prices. So again, it comes down to that supply and demand side of things. So you've got to watch out for the developers kind of controlling the prices, because they get 20 first home buyers coming there, but they can just as easily, once you've bought into that property, they're just going to release another 100 or another 10 or another 10 and another 10, and that constant supply is not putting any pressure on the suburb itself for the prices to grow. So yeah, and also if there's multiple developers competing for each other's business, they may all just try and develop at once, which then floods the market, which then means your price is going to drop as well. Yeah.
Joe, I think you got all fired up. You got all passionate again, man. Look at Joe go. He's twitching. He's twitching at the moustache. Look at him go. But no, I think you guys.
Good question. You guys know there are some good developers, right? Absolutely. And I don't think that, like, I have a lot of friends that have used house and land packages for their dream home. They love it. It's the best thing ever. You got to choose the color.
I've developed. So I mean, I'm not a Metricon or I'm not a big sort of large scale developer, but But I even sort of saw that myself when I was selling. Like one of the selling the properties that we developed, one of the options was to go through a company that was going to be paid a good amount of commission to sell our property. So the end user is I'm not necessarily, I'm going to say, well, how much can I get for that property to make sure I'm recouping some of that sales commission, which is all, like, sales commission is there when you sell a property anyway, but it was significantly more than what it would have been for an existing property. But of course, there's good developers.
Yeah, well, I've currently got a development project myself personally under contract, and we're going unconditional next week. So if we end up pulling through, if we end up going down purchasing that, that'll be a 1 into 3 site where we're buying the property. It's on a corner block. We understand the zoning rules. It doesn't look like a 3 site, but as we understand that there's a park next door, we get an allowance for developments. So it allows us to split this into 3 properties. We're just going to sell off the 3 properties as land, as house and land packages. So we are developers as well, but it's just making sure that you do it ethically and don't just palm it off to investors trying to say it's investment stock when no, this is for owner occupiers. This is not like you can invest in it if you want, but not ramming it down people's throats, I think is important.
I'll be honest, Joe. If an investor's willing to pay the price that I want to sell it for, then I'm not going to decline their offer because. But yeah, that's fair enough. So shall we get on to number 2?
Number 2. What is number 2, Jeff?
So I sort of feel like I stole your one here, Joe, because this should have been your property playbook. I don't know why you didn't pick this one, but my sort of thing I like to look for is aim for value add. So I think Joe could do a whole 5-hour session on this. But what I mean by aim for value add, and of course this is only me, so I'm not saying everybody has to do this, but this is what I sort of like to focus on. It can be anything from a small renovation, such as doing a kitchen or a bathroom or something like that, or even adding a room, to a decent sized development. So why do I think that this should be? Because 2020 and 2021 we saw property prices increase. If you bought pretty much anything, you bought a shoebox in the middle of Broken Hill, probably, I mean, not to throw Broken Hill on the bus, sorry, Broken Hill, but I'm sure a lovely place. But traditionally, there's not necessarily a lot of capital growth there, but it does grow. But if you bought there, you would have probably seen capital growth. But I want to show you some numbers for the 2022 sort of calendar year. So I want to show you what happens in more of a, I suppose, a regular. This is probably maybe not necessarily a regular market, but I'll say that it largely is. I'm just trying to find the correct. If I can, here we go. So these are the core logic numbers for December. Is it big enough, Joe? Am I going to need to make it bigger?
Zoom in.
Zoom in.
Plus. I'll move our heads out of the way.
Yeah, that's all right.
Yeah.
It's probably too big now. So if we look at, these are the index, these are the price results, and they're only medians. So of course you could throw the comments about the medians, but you look at Sydney. Look at that, down 12% in dwelling values. So this is houses and units. So down 12% on the year, 4% on the quarter. Melbourne down 8%. Even Brisbane slipped into negative because of the quarter. Had a shocking quarter in the last quarter of 2022. Adelaide is a bit of a shining light, but it is starting to come off. Perth's just sort of chugging along, and there's pockets of Perth, as you've seen, Joe. Hobart is starting to struggle quite a bit as well. But why am I showing you this, though? Because people who bought in 2020 or even sort of started 2021 must have just thought, oh, this is like money for jam. This is easy. I can just buy anything and it'll make money. So, but I just wanted to show that to illustrate to people that yes, it is. You need to be a bit more selective now if you're looking to sort of see capital growth, because capital growth isn't guaranteed anyway as well. And the way you can potentially do that is renovation. So. And it comes back to what you want to achieve. If you're happy to sort of sit back and wait 25 years, then maybe renovation or development is not for you. But if you want to, there's ways you can add value for things such as through cash flow, like there's granny flats, which potentially reduces some of the value of the capital. There's short-term rentals we had Sean on last week, co-living, even as simple as a 10 or 15K reno can add. What have you sort of seen in that adding value to what, $20 a week to the rent? Maybe even $30. How much value does a 10 or 15? Obviously, it depends.
Well, it depends on the area, but it's also like if you can move the property in a 4-bedroom, like a 3-bedroom to a 4-bedroom, and keep the same kind of functionality, you're going to get away. People are just going to look at that property.
The capital worth as well, which is what I said. Adding additional bedroom or bath as well. Bath not so much, but bedroom can certainly help, provided it works with the configuration. And then you can even go into things like small, large-scale development, which is not for everybody, I will say. You shouldn't try this at home, kids. The things to be aware of as I wrap this rule book or playbook up is you need to understand what the demographics of the area wants, because if you go in and buy in an area where the median's 400 and you go and buy a $600,000 or $700,000 or $800,000 and you put granite bench tops in, I'd say you're over capitalizing. So you need to be cognizant and aware of that, and understanding the cost benefit of doing a reno or a development as well, because you can very quickly lose money from a development. And even I've done a reno and I've done a couple of renos, but one of the renos we added a deck. We spent $50,000 on a 300-ish K property, and it just wasn't the value add in that particular area. People didn't necessarily care about the deck in that type of property. So that's my playbook number 2. What are your thoughts?
Yeah, I think the value add playbook is something that I integrate into every purchase that I buy. You have to, like, it's just, how do you de-risk your investment as much as possible? We all know that we're buying these properties for the next 20, 30 years. That's what we're doing. So one thing that you mentioned, right, that you can see that generally speaking, pretty much all of the markets in Australia are trending down. That post that Hayden did had different segments of the market are affected in different ways. Some are growing, some are shrinking. So you just have to kind of look at it from a different lens. But one of the things that I'm seeing a lot is, especially from investors, investor clients, is that we're all looking for more cash flow. Cash flow is becoming a much bigger focus. And I think that the types of assets that provide a better cash flow, like this is why Perth is being so popular right now, because one, it's one of the most affordable markets in Australia now. South Australia, is starting to see it become very difficult, not very difficult to buy in, but it's getting very unaffordable. It's kind of hit almost at not almost at its peak is not a fair thing to say, but finding a great deal is very challenging as it was.
I think unless you've got like anything, you're not going to find too much under 500 in Adelaide. Like, yes, you can go to the north, you can go up sort of Elizabeth Way, and I think even that sort of did see about 40% growth last year. So the challenge you would have with that is you're starting to potentially compromise on some of the, and it's not to say you can't still make money, but do you want to do all that sort of, and if you're comfortable with doing that, then maybe look at that option.
Yeah, I mean, and the development side of things as well. Like, I've got people that they're like, no, I know, I'm not developing. I'm not a developer. Well, that's fine. Let's just buy a property that has development potential built in. And then you're not a developer. You don't need to be a developer at all. But you now know that this ticks the boxes for development. You understand the town planning rules. You understand what is subdividable, what is not subdividable. And you can then, one, spend $5,000 when you try and sell it in 10, 15, 20, 30 years. Go to an architect. Hey, can you just draw up some plans of what designs would look like? And I might be able to sell it on to an investor client or someone who wants it as a development site. And you can get a nice little juicy ROI. Get a premium for your property at least.
So Jenny, one of the, she said increasing cash flow, decreasing both positive impacts on servicing. Yeah, that's another sort of, there's so many aspects to this property playbook. Joe, can we ask, you said you wanted to make it interactive, so I'm going to put you a little bit on the spot. If you don't want to answer it, I will. But somebody said, I think this is Tanya. It was Tanya Cook who said, last year you guys thought Rockingham in Perth was a good investment area. Just curious if you still think so. Can we quantify that though, and just say, did you think it was a good investment area? I mean, we profiled it, but I want to make sure that we're both on the same page, Joe.
Look, I think if you did, buy in it, you would have done pretty well when we did it. So I'd say we were kind of saying it is a half decent market to be buying. I didn't think we were pushing it really hard, but we just did a data deep dive, didn't we? Was that what we did?
Yeah, we did. Because we wanted to go west, because we sent you over to WA. We need to send you somewhere else soon. I think we might even have to send. Yeah, we have to send you on a plane somewhere.
No, I'm going to WA in 2 weeks.
Oh yeah,
yeah.
Jeez,
I think the next
you really are jet setting. It's impressive.
But what are your thoughts on Rockingham, mate?
I tried to find an area a little bit, because you chose right in sort of down. I think you chose down Secret Harbour. Like, you chose right in Rockingham. Well, you chose right on the marina, whereas I went a bit inland and looked at Coolangup. And Coolangup, I thought was an interesting area. I probably would have been very cautious in calling up. I mean, I've not visited the area, so that would be my number one property play before I even considered that area. I think yes, you've probably done well in that area. I think you have to be a bit cautious because it's seen a lot of growth. So, is it still affordable for that market? And what are the fundamentals say for the next 3 to 5? Like back when we looked at it, it was still quite cheap. It was still, I think it was sort of mid freeze, wasn't it? Low mid freeze. This was almost yeah. So it was pretty affordable for that area. And I think I don't know what the median of Rockingham is now, but I think it's gone up quite a bit. So sort of low fours maybe.
Yeah, it's definitely grown. It's definitely grown a lot. So yeah, I think there are pockets within Rockingham that are well worth investment. There's a lot of infrastructure going in, like we said back on that session. There are definite pockets you don't want to be buying in within Rockingham. Like I'm talking about because there's Rockingham Suburb and then there's the Rockingham LGA. So the LGA is what I'm talking about here. Rockingham, the suburb, has probably had the most out of all of the suburbs that I've ever bought in. It has had the most amount of investor activity that I've ever seen. I haven't seen anybody. Every investor that I know is like, "What about Rockingham? What about Rockingham?" So what I am starting to see is it's becoming a little bit more challenging to get. It's a little bit challenging to get tenants on some properties. Now, none of the properties that I like, we haven't bought in the Rockingham LGA for 6 months or something like that, but other pockets around. But anyway, just be wary that don't expect an amazing piece of rental growth. You've got to look at the affordability of a suburb, and this is like some of the fundamentals that you have to look at. How much can people in Rockingham actually afford in rent? Okay, here we go. You've brought it up here. But how much can people actually afford to pay in rent? Because although supply and demand comes into play, it also gets to a ceiling. Like there's a ceiling.
The yield's starting to come down as well. So you sort of start to say it's below 5% now.
That means the prices are growing though.
Yeah, it does. Yeah, units. Yeah, be very cautious. Even though it yields 6% for a unit, it depends on. Yeah, I mean, depends on going back to your reason for purchasing, but. Yeah, I'd be a little circumspect in terms of Rockingham now, not to throw shade on the area, because there's value in a lot of areas, but just be.
I'm just talking Rockingham suburb, Rockingham LGA. I still see a lot of interest.
Yep. Okay, we'll go to playbook number 2 for Joe, and then we're going to throw to an ad. I think location.
Well, this kind of, I don't know. I don't know how to frame this rule, but it kind of comes into play about your budget side of things. So, I guess it's actually talking to exactly what we are talking about now with Bundaberg, right? So you've got to look at there's 15,353 suburbs. 3,800 of them have reliable data, which has enough transactions, enough sales volumes for you to actually work out where is worthwhile. So all of a sudden, boom, we've gone down to 3,800. Then you're going to overlay your budget to that. And then what you're going to do is overlay your buyer brief, which is, who are you? What do you want to buy? Well, I want to...
Weren't we starting with budget first, Joe? Shouldn't we start with budget and then go to the locations?
Yeah. Budget, buyer brief.
Yep.
Yeah. Right. And then, and then the analysis. So I guess this is actually going to talk to my third point as well. So I use a pretty basic frame. Well, it's not basic, but it just sounds basic. It's called FAB, fundamentals, analysis, and boots on the ground. And we talk about this all the time. What are the fundamental drivers of demand to the area? So talking about Rockingham, who are the people living there and how are they going to drive capital growth? Who are the people there? Can they afford to drive up rental prices? Who are the people in Rockingham and can they spend an extra $20 or $50? There's going to be a point where they can no longer afford. So they're going to then ripple out into different suburbs and try and find more affordable stuff, more affordable properties. or sacrifice on type of property, right? Other fundamental drivers are employment. Is there a diverse workforce in that area? Is there good, stable jobs? Is there money coming to the area? Another one is projects. What projects and infrastructure is going on the area? Are there any big projects that are going to bring people into the region and make them stay? So one infrastructure project might be, there's a town here and there's a big highway that's going, through and around it. Well, that's not a good infrastructure. Although it may be 100, 200, 300, $10 billion highway, it's actually just going to cut off that town completely. So that means the population is going to start dwindling. The employment's going to start dwindling. And then one of the other fundamentals is desirability. What is drawing people to these locations and what makes them want to stay? So what are the draw cards for owner-occupiers? So generally speaking, about 70% of the population is owner-occupiers and then 30% rentals. What you want to be doing is picking a market that has a higher rental proportion, but not incredibly high where you can't get a tenant because no one rents there as well. So you want to kind of, stick within a bit of a range for that.
Brendan brought up rules around percentage of renters in an area. Do you have a limit? Is there a limit, Joe?
Is there a limit? Yeah. So a good Joe rules around percentages. Yeah. Okay. So a good rule is 15 to 35% in between there, is where you can start to, as soon as you start going above 35%, even look at suburbs that have a higher renter proportion. You just won't see the prices. You just won't see the prices going up as much because the owner occupiers are the ones that are driving the value. All we're doing as investors is riding on the coattails of the owner occupier. Like that's really what you're trying to do. You're trying to go to a suburb that everybody else wants to go to as an owner occupier and think, you know what, why would owner occupiers want to be here? They've got good desirability. They've got good jobs. They've got good infrastructure. There are amazing projects coming, good schools. Yeah. Why do you want to live
They've
here?
got the nice Italian restaurant down the road. They've got the trendy cafe that serves kombucha. Not that I'm saying that's what you should be living.
And then it comes down to, so we called this location as a rule. Really, it should have been just called data. So things to look at. So that's kind of the high level, like suburb SA3, if you will. Like what are the fundamentals for the area? And then you want to see days on markets trending down. So you want to see people like properties leaving quickly, sales listing volumes dropping down, inventory levels going down, vacancy rates going down. Vendors discounting less and less. I know it sounds like you want them to, it sounds like you want to get a discount as much as possible. But if they're tightening off there, they're saying, oh, actually, I can hold on to this property a little bit more. It means that there's demand and people are there paying for it. So those are some things to look out for as well.
I love how Hayden's a bit of a contrarian, and he says he's done it all different, but that's okay. That's what I love about property investing. There's no absolutely one correct property playbook, because if somebody says to you that they have the absolute answer to every property investing thing, I would be a little cautious of that person, because I'm not going to stand up here tonight and say that I do have every part of property investing figured out. I'm okay with admitting that, Joe. Yeah.
I think you can, like, this is the beauty of property as well. There's so many ways to make money in different ways, different markets. I guess your goal as an investor is to work out, there you go. That's a great statement. My strategy is best for me. And that's what you've got to work out for yourself. What is the best strategy for you? So for me, I've decided that like I love commercial property investing. I think that is a great place to end up. Right now, my strategy is renovation and subdivision, so I can build a large enough asset base so I can then get to that point as quickly as possible to have that nest egg and then convert that nest egg into commercial property, which is going to be a cash flow asset. So for me, I don't look at in commercial property whatsoever. That's not the playbook that I go down. I don't look at it at all. I go to Steve Polisi. We're going to run a Steve was just thinking this is the perfect time to introduce the Steve Polisi ad, but I think that last one wasn't it?
Yeah, he was first up this week.
Yeah. So anyway, but you have to figure out what your strategy. If your strategy is commercial and you've come up with a way that commercial works for you, boom, just focus in on that. Whatever's going to work. If you become an expert in developments would definitely work for you. But if you become an expert in commercial property, renovation, subdivisions,
short-term
you
rentals,
see this all,
whatever it is.
Yeah, Airbnbs, and then so all of this stuff, like you're not going to become an expert. It's just too hard.
Are you saying, Joe, you can become an expert in off the plan, or is that a no? You can't become an expert.
No, I think you can actually. I think if you, and this is a part of the justification I have for off the plan. I do not think overall off the plan apartments and house and land packages are a good purchase, especially off the plan apartments where there's massive oversupply. The main reason is you are buying, let's say there's 1,000 houses units in a complex on 1,000 square meters, just to cut it up. So you have one 100th of land component.
Yep.
That's no amount of land whatsoever. And if someone decides to sell their property for less, you're going to keep, it's just the prices are going to drop. There's no reason why your house is better than their house, but their house just sold for $20,000 less. So the most recent sale is theirs. And think of a market. The market is made up of 25% of people that need to get out right now and they're willing to take a discount. There are people that are like, oh, I kind of want to leave, so I need to, float about and I'll probably take a discount. To people that are like, oh, I'll just see what the market does and I'm not going to take any less than this. And then there's unrealistic high expectations. So in all of those markets, there are those four types of people out there in a market. So you need to find, the first two in the good assets as well. And then that's how you make it a good deal, because a good property doesn't necessarily mean it makes a good deal because it's, one of these vendors that has unrealistic expectations. I feel like I was going somewhere else with that. But I got lost.
Yeah. You said something about you need to pick your strategy and focus on becoming an expert.
Oh, yeah. Yeah. So you're saying is there an off the house and land package person that can make it rich? Absolutely. Like all I say is 99% of those deals do not work. They're no good. But if you know how to find that 1% and you spend all your time, energy, and effort onto that, sure, you can absolutely make money. But I think you would slowly start to realize that that's a very difficult game to play when you could just buy an established dwelling and make your money there instead. But yeah, you can become an expert at that and probably make a whole heap of coin.
Yeah, there you go. Nicely done. Okay. Speaking of making a whole bunch of coin, why don't we negotiate some money off a coin?
Oh. This live session is sponsored by Scott Agate from Hello House. Scott has created the world's first property negotiation as a service business. So what does that mean? Well, let's think about it. When was the last time you negotiated on anything over $100, let alone a property that is going to be one of the biggest investments of your life? The vendor, they have a trained negotiator on their side in the form of a real estate agent. That's kind of like you stepping into the ring with Mike Tyson after never training a day of boxing in your life. These guys are trained professionals, and that's what they do day in and day out. And this is what Hello House does every single day as well. They negotiate on property to get the best buy price from the real estate agents. Scott Agate, he's the expert negotiator. He has been in this industry since 1995. He owned and operated 3 Bell franchises. Scott was the guy that was teaching these real estate agents all these agent games. He knows all of their tricks. Having him on your side is going to give you a massive unfair advantage and literally save you tens of thousands of dollars. Unlike other ways of purchasing property, Scott's incentives are aligned with you, the buyer, meaning the more money he saves you, the more money he makes, which is what you want. You need to have those incentives aligned. Scott has kindly offered our group a massive discount on the retainer fee for his service. So if you're looking to buy your next home or investment property, click the link below to get in touch.
I've dropped a link there to his course because I think that's what he focuses on now. But he also, yeah. So Joe, what did we learn in our first two? Should we sum up what we learned, or should we just go straight into number 3? I'm easy either way.
Let's just go in. Let's just dive in. I want to get some of these questions, some really good questions in here that we.
Could you bring up one of the questions? I wanted to, because I'm next up. That's why I wanted you to summarize. Rather than borrowing more, I'm doing smaller
um,
private lending to pay. I think it sounds like Jenny. Is that Jenny Mole who's doing that? It sounds like something Jenny's doing.
yeah, it's yeah, rather than borrowing more, I'm doing small developments. Exactly right. Like, and also private lending to pay off a large chunk of my PPOR. The amount of people that come up to me that are not property investors, but want to do property investing so they can buy a property in Sydney is unreal. Like, if you're looking to buy a $2 million, $3 million property in New South Wales, like I live in Cronulla, if I want to buy a house, I need minimum $3 million. So am I just like, if this is a goal that I want, the question is, how am I going to get there? And these type of like using property as my vehicle is the way I'm doing it. But this person does it completely different as well. So I think this is awesome. So she's, or he, I don't know who it is, but they're using
Jenny.
Oh, go Jenny. Private lending, where she lends out to other people and gets paid a percentage for the deal to pay off a PPOR. The debt is killing her servicing. But what this is going to do, she's going to be reducing her debt as much as possible, which will then open up her serviceability so she can then buy again. Well done.
Yeah. I think, the only one that I'd say is you need to really absolutely do due diligence on the people. I mean, the deal, yes, is important, but the deal can suck up, but the people may not. So yeah, I know that Jenny in particular, if it is her, is that she will be very thorough. But yeah, Joe, it's only buying a cheap one in Cronulla. I know Joe doesn't buy cheap. He buys. I think that's probably Brendan.
Yeah, exactly. Yeah, he knows the prices in Cronulla.
So Matt, this is an interesting one. Here we go. This is going to be. I'm going to throw this one to you, Joe. Is buying land in new estate at pre-registration price. Actually, maybe this is a question for me. Then doing a build of your choice, the same as house and land, in your opinion. I would say my understanding is not. I haven't necessarily done one of these, so I would always defer to somebody. But my understanding is your pre-registration price is you're essentially taking on the subdividing. You're subdividing up. You're lodging the application. I mean, you need to. Yeah, so I mean, it's not. I don't think it is the same as house and land because you're actually then becoming the developer yourself rather than buying the finished product. So. I think that if you're gonna, that's probably the one of the few ways if I was buying a house and land that I would probably do it because, well, it's not really you're actually becoming the. So I think you need to understand what the value of the finished product is. That's the risk, and particularly it can be hard to estimate. In larger estates in Stockland have seen good growth price in land prices. Well. I mean, yeah, I think if you're buying where there's already somebody developing, I think I would be a little more cautious then because you're somewhat then. I mean, it might look like you're making good growth, but the problem is how much land can be released, and it is that you might have seen good growth, but yeah, you really just have to be careful with supply and demand there. I think.
Yeah, that's kind of echoes what I say again. You're going to be getting a smaller block of land. So a 400 square meter block is not going to sell as much in 20 years as a 600 meter block is going to do. The 20-year-old house that is currently on the 600 square meter block is going to be exactly the same state or as your, one right now in 20 years time. So I would always try and go for larger land size. But yeah, you're 100% right. If you are what you're doing right now is you're taking on problems and difficulties and time, energy, and effort into getting someone to help you build it and develop it and going through all that process. So you deserve to get rewarded for that. If you just hand the keys over to someone else and say, hey, you do this, then you need to pay for that, and you'll pay for that through, $10,000, $20,000. This is how you get these $40,000 fees because the developer takes the cut as well. So yeah, I think if you're able to negotiate the price down really well and then negotiate with good builders and you're not limited on your like what you do with your land, then I think you're all right. Yeah.
Yeah, there is a bit more aggravation in it as well because building is an absolute pain in the backside for anybody who's done it. It's you very rarely get a build that goes completely kind of according to plan. There's usually one or two, hopefully not more than two things that will go wrong. So you need to expect that things may not go according to plan. and that's okay.
Very true.
So let's get on
What
to
is this?
Oh, number 3. Rule number 3, or playbook number 3. It's not about the number of properties. It's about the LVR, net worth, net cash flow. So this is because, yeah. What were you thinking? Do you want to steal this,
Well,
Joe?
no, I mean, I want 10 properties in 10 years. Like that's the main goal that I want.
But
Isn't
Joe,
that the best?
you don't need
the
10
best way
years
to
to
go?
get 10 properties, though. You could, if you had enough, you could easily just go and buy 10 properties for 100K each, and then you'd even become a millionaire. But so then you'd have the value of those 10 properties would be $1 million, and what would the rental return on that be as well? I suppose. Let's assume you've got a gross yield of 7%. So yes, you might be getting 70K gross income on that. We're playing through a bit of an example here, and then but the assumption is then, like, have you got debt on that property? So is it at 80%? So if the LVR is at 80%, then let's just say they're at 5% loan. That's probably round figures. So 8 times 5, so that's 45K in interest alone you're paying on that rent of. So straight away you're already losing more than half of that too. And yes, you can pay it down over time. So I'm not saying that you can't. But then the other thing I would say is you're then relying, if you're buying $100,000 properties, they might grow 20, 30% or whatever it is in, I don't know, 5 years, 6, 7 years. That's $20,000. And yes, you still made money, but how do you then keep buying the next property? So you got to keep coming up with a deposit to buy that property. So
Yeah. And also, there have been massive storms in Victoria, and I just saw a post about someone who had their entire bloody half a roof collapsed. Exact same thing just happened to me. If you've got 10 older, rougher properties, I would not want to be running those. Also expect larger vacancies. They'd be in less desirable areas. But to be honest, based on, Australian property has grown. It's different numbers for different things, but what I recently saw on CoreLogic was at 5.9% Australia-wide nationally. So that is
was that 2020, 2022, was it?
I don't even think it did actually include 2022. So it would be even more. Yeah, you're correct. But you can actually achieve your goals if you structure your property portfolio. And this is why property planning is such an important process, because it allows you to look into the future and you realize that you can actually achieve what you want with 3 to 5 properties. You don't actually need these massive portfolios like people talk about. Exactly what you've got here. It's about the LVR, the loan to value ratio. How much of these properties do you own? What is your net worth? And most importantly, I want to retire. I want to make my salary, right? So I want my net worth in cash flow. And that's it. That's what
the other so essentially what my playbook here is it's about your exit strategy. So because I think a lot of people discount when they just buy, and don't get me wrong, like, of course you have to take action. You can't just sort of play it out on paper, because if you only play it on paper and don't take action, then you won't ever get any result. But I think a lot of people don't sort of appreciate what they're actually aiming to do. And then they say, they just throw a number out there. They say 100K kind of passive income, but they don't also realize that on that 100K, you're going to have expenses of maybe, if you've got management fees, you've got insurance. So you might be lucky to make sort of 65 or 70K of that 100. So you will have expenses on that 100K. So I think the exit strategy is important. It doesn't mean you need to sell the property. People think when you say exit strategy, it's like, oh, I have to sell. Like that is one potential option. You can sell some, or you could even, the exit strategy for me is how you actually being able to retire or stop working or whatever it is. That to me is what I like to think is an exit strategy, but there's multiple types of exit strategies. So what are your thoughts on that, Joe? Any questions? And if people have questions, I'd love to, what are people's thoughts on this as well?
No, I mean, I guess it's a thing of I feel like this was big probably actually when you and I were at seminars and stuff like that. Everyone was pushing for, you need 10 properties. I even have people now coming up to me saying, look, my goal is 10 properties. Is it really your goal? Is your goal actually an end outcome of $100,000 or $200,000 or whatever that number is. And then you just reverse engineer it. Like, how much cash do I have on hand? How much income do I earn? How much equity and cash flow, how much equity and cash do I have on hand? And what is my serviceability? What is my debt to income ratio? And if you can chart that out, there you go, you need 6. But you can chart that out and you can see, okay, well, based on what it is now, we need to buy a property today at $500,000. We need to add value to it. It needs to then grow enough value that we can pull out our equity to then buy another property. Then in year 3, we're going to have a mixture of cash and equity to be able to buy our third one. And that's going to cash flow at X. I would prefer 3 properties debt-free than 10 properties with 80% LVR. Yeah. 100%.
Particularly if they're commercial properties worth several $1 million and they're yielding sort of 7 or 8% net, that would be all right, wouldn't it, Joe?
Yeah, well, look at buddy Steve McKnight. You know, he went from 0 to 240 properties, and now he owns 3 commercial properties debt free.
0 to 360, Joe.
Is it? Oh,
maybe it's 260. Yeah, it's 260. Sorry, it's 260. Yeah,
there you go. Yeah. So does this make, actually there's one here that says, does this involving sell down at the end, so you have 0 debt? It can be if you want. You can sell down. It's an option.
I mean, there's ways. I mean, people will say you should only go interest only, and I mean, if you get the thing of going interest only is you're not ever reducing that, and of course you got tax deductibility on the interest. So if you're paying it down, you're losing some of that tax deductibility. You can have an offset, of course, as well. But yeah, there's so many different ways you can do it. I think I'm going to try and avoid selling properties now if I can.
Yeah, and also, so what happened? Like, one thing that I always see when we're building out a portfolio is that we have a ceiling, a glass ceiling on serviceability. So you're going to get to a point. You're not going to be able to buy 10 properties, typically speaking, 10 good properties. Sure, you can buy 10 $100,000 properties and go down that route. Great, you do that if you want. Not what I recommend. But you can. Lost my point again. What was my point of that? Sorry.
What was your point, Joe?
I didn't get to it.
About sort of selling down properties versus paying down debts, or versus like having the number of properties. I'm just saying things now.
Oh well, that'll come back to me. Come back to me at some.
Well, I think we should go on to your last point, unless I think that's been a lively kind of interesting kind of playbook. Because I think I don't see it as much these days, I've stopped seeing it as much in property sort of gurus advertising about. And look, I don't mind people putting in advertising, but I don't see it as much because it's probably harder to attain that sort of 10 properties in 3 years or whatever it is. It's harder to get that, so they sort of just stopped because it was just too unrealistic.
Yeah,
but, your boots on the ground, Joe.
Serviceability hits the limit. Boots on the ground. So this is another fundamental rule, and like it's funny. Like I see people that jump into courses and they're like, you know, didn't even fly to the location, didn't get on a plane, used other people to, you know, property managers to do it for you, and I'm like, oh yeah, sure, okay. I think if you're spending hundreds of thousands of dollars, just book a flight. No matter where you go to Australia, it's under $1,000. So you should go and fly to that location, or have somebody else fly to that location that you trust, that you know well. So why is it so important? The most important thing, to be fair, is the data, the research that gets you to that point. It gets you to that location. The location is going to lift 80% of that asset. There's a particular area. There's a particular suburb that I'm thinking of. They literally have a pocket where it is a cutout. Like, they've cut it out of the town, and it is just terrible. Do not buy there. Never buy in those pockets of the suburb. But you see $100,000 price difference.
Can you share the state that it's in, Joe?
Sorry? Yeah, it's in Victoria.
Yeah.
In Victoria. But yeah, it could be anywhere. Like a lot of suburbs have their no-go zones split up. Some have them all concentrated on one pocket. It all completely is all completely different. And also it depends on your strategy, right? Like if your strategy is like the whole, trying to gentrify up and get into properties. Yeah. If you're trying to go to locations that are not yet gentrified, like that can be a strategy where you can make a lot of money in like a poorer suburb, but it's moving up in the world. So again, your strategy. But that last 20% is what boots on the ground is. That last 20%, you don't want this 80, like it's 80-20, right? 20% of the work is done. Whatever the 80-20 rule is and how to explain it. But you need to fly to the location and make sure that you're buying in a hot spot and not a not spot. Because buying in those not spots will give you that stigma. And one of the questions right at the beginning was like that post you were talking about, Jef, like don't buy in bad places because they still grow, but they generally grow at the same kind of rate. So there will always be a gap between the good places and the bad places. So if you find an amazing, incredible suburb, you can still buy in it, but it's not necessarily going to be the best outcome for you. So one of the things, so I've got a whole list of things when it comes to visiting the location in person. So boots on the ground is exactly this. It allows you to, it is you getting on a plane, renting a car and driving around the suburb, meeting the locals, talking to the real estate agents and connecting with people to try and find the best properties, get the best insights and things in the future as well. A lot of things you actually see are like what infrastructure projects are going in. Is there a new Coles? Is there a new Woolies? This stuff doesn't really show up online too much. You don't hear too much about it, but then you see a new building getting put up. Okay, great. There's going to be something there. Getting boots on the ground allows you to understand the
I just had to bring this up. Brendan says, careful, the rival group pushes, you don't need to fly location. Didn't you guys chatted about that? That's I don't think they're a rival group. I think we can all win in property. I know this rival. I mean, which suburb will you be boots on the ground?
All of the good ones. Actually, yeah, that's actually a really good point. Which suburbs will you be getting boots on the ground with? Well, I mean, I've already been to Perth and checked out a number of locations, but some new locations have popped up on the radar, and that's exactly what you have to do. So you are looking 15,000 suburbs, you get narrowed down, but the data is only so much. The data is what kind of is your barometer, and it leads you to a location, but you have to go there and check it out and make sure that there are things happening in there and the area is growing.
Can you share which direction from Perth it is, Joe? You don't have to.
Well, north and south, both.
Okay.
Like, but it's just not east. It's not. Don't go east of Perth.
East. Okay.
I mean,
so you don't like east though.
Well, I mean, not too far east. You'll end up in Sydney. No one wants to buy there.
Yeah. Here we go. Let's. This is interesting. Any thoughts on the Sunshine Coast, Matt? That's like. It's like saying any thoughts on Sydney. Like which part of the? I mean, I don't really know the area that well, but we can kind of crowdsource it. Which part of the Sunshine Coast? Because that's a huge section of area. Like I think that's the thing when people are like, well, what are your thoughts on Melbourne? It's like, well, I don't even like Melbourne as a thing is just so big, or even Perth. Like,
yeah.
Let's see. Give it up, Joe. I want to come and do a good point. Palmview, I'd say. I don't think. Have you even heard of? I haven't even heard of Palmview, if I'm very honest.
No, it doesn't come up on my radar as a investment for me.
But anyway,
that doesn't necessarily mean it's not. If you do the research and you do all the data and stuff, then it might be worthwhile. So what is boots on the ground actually? So it's looking for, like I said, property, like initially the property condition, but we want to be looking at the neighborhood. So we want to be identifying our neighborhood vibe. Like you can get a sense of a neighborhood with shopping trolleys strewn on the floor, graffiti all over the place, cars on stilts on a driveway. Another thing to look out for is either a car on the lawn or like dead grass all on the lawn because cars have been parking there. So they might not be there right now, but it's a little bit shady. Distance to amenities. You will drive to a place and you'll be like, oh wow, there's no bus stops here, and I'm actually quite far away from town. There's no school. There's no reason why I want to live here, and to get to anything is very challenging. So you might want to avoid stuff like that. You want to look for future development. So new constructions, because if there's an area that's getting some new developments, it doesn't necessarily mean the entire area is like that suburb is bad. No, it could actually mean this area is gentrifying. This area is getting more money. People are moving here. First home buyers are moving here, which is a good sign. Yeah.
I wanted to go back to just quickly. I looked at Palmview, and it's there's a lot of green sort of. It looks like an acreage sort of area. So those are my initial thoughts. I'd be kind of cautious on, like, it's 800K median house price in that area. So imagine there's a lot of like big kind of acreage, and they'll potentially sort of slice those up if council allows them to. So just it depends on what it goes back to what your strategy is. If that is your strategy to sort of make the sort of subdivision play, get and if you have the skill set, let's say that's what somebody said. Decent houses, family area, doubt it's going. Yeah, that's sort of, those are sort of, I mean, my cursory glance. Yeah, but yeah, boots on the ground. I agree, Joe, because there's nothing that beats. You can hear, you need to actually sort of, even as you say, speak to the publicans, speak to the news agents, sort of understand what those people are saying about an area, and it's what they're not saying as well, I think.
Ah, cool. Yeah. So boots on the ground. We're just going to look at Palmview real quickly.
Oh, we're going to do it. Jeez.
We're going to have a look at Palmview because I just saw some real big red flags in this suburb.
Well, that's what I saw too. But yeah.
So this is Suburb Trends. It's a great little platform created by Kent Lardner. Super nice dude. But Palmview is out here in the Sunshine Coast.
That's the city.
What a name, Sippy Downs. That's great. But the challenge that I'm seeing here is exactly the challenge that Jef has. This is all new estates. So all of this land here, everything that the eye touches is going to be turned into new estates. So again, we're going to have a large influx of supply of properties. We can already see since January last year, inventory levels has been rising. There's a lot more listings on the property. Where are we talking days on market? So it's currently 39 days. So it was 39 days. It's now increased from 35. So days on markets are increasing ever so slightly. 12 months have grown. Rents have grown, increased by $80 a week. Vacancy rates for the area is low, which is very good to see. And the prices are a little bit distributed, but that's not necessarily a bad thing. A lot of them are at that $600,000 to $800,000 range. But the whole suburb is just new estates. Like, this is just build it and they will come. I wouldn't be thinking to buy one of these lots and then thinking that I can turn it into something, because if you look over the other side of the tracks, they're already doing that, and you're just going to be competing with all of this kind of thing. But also, this is probably made up of two suburbs, to be fair. You've got all of this here, Bruce Highway, which is bloody massive, and then this side here. And then we've also got the profile. So you can actually see the people that live here are not ranked. This is the CIFA rank, which is social index distribution for money.
That's crazy. That's crazy they've actually done that. Jeez.
Yeah. Elevation. You don't need to. And then top streets. All on the. Yeah, there you go. All the top streets are on this new established side. This is all the new off the plan house and land stuff. So, you're not a place that interests me whatsoever.
Well, yeah, I mean, there's, it can potentially, like, there's a suburb fairly close to me, Wongawilli, which you could have made hundreds. You could have made hundreds of thousands of dollars if you sort of bought there. But the challenge I have with it is that you don't know how it's actually going to go. Like, it may go fantastically well, but you really need to be. You need to have an outsized sort of like if I'm just somebody who's not a local, you doesn't understand sort of the dynamics, and you want to be a bit cautious.
Yeah. Yeah. This is a big one. I'm not sure you know the small coastal town of Bega.
I've heard of Bega. Of course, mate. Cheese,
Yeah.
Bega cheese.
Yeah.
Bloody hell, of course I
No,
know.
no property to rent in the market most of the time, but no project for infrastructure there in the future. For example, there is only Woolies, Coles, and Kmart, medium price
That's all
houses,
you need.
700K. What do you think about investment properties compared to the big cities? Thank you very much. It's made money. Good.
Well,
Bigger.
yeah, it's interesting. We were looking down the Sapphire Coast, weren't we, at one stage? Not
Oh, yeah,
not
that's right.
you
Yeah,
as in
yeah,
your. I was sort of looking for it as an investment, and would have done well at the start of 2020. But my concern is like why are people going to keep paying? Why are people going to keep paying money down there? And like I don't know. It's like it's one of those ones that yes, it could. I just don't. I don't feel comfortable enough about it. As in, it's kind of like Byron. Like, why do people keep paying millions of dollars in Byron? And it's because it's Byron. Like, I don't know. Like, I like to sort of, I like to de-risk my. It could go fantastically well, but I don't know. It could just sit flat because is that affordable? Because I think the thing that could be driving is people could be retiring to those areas.
Mm-hmm. Yeah.
So yeah.
Anyway, back to the boots on the ground stuff. Yeah, I just wanted to finish this off because I think it's important for people. What you can do is create a bit of a scorecard for yourself. So if you go to a suburb and you get, what will generally happen is you'll find 3 locations, and you'll want to go and drive around each one of those suburbs and just get a feel for the whole place. But what you can do is just set up a 1 to 10 score and just get a piece of paper and just type like infrastructure. What kind of infrastructure is going here? Crime rates, what's going on in here, undesirable demographics, unsafe streets, how many unsafe streets did I have, and just mark them all off on 10. And then you can create your own scorecard. You got 5, 4, 6, 1, 2, 3, 4. Great, this is a 24. This one's a 32. I much prefer to buy in the 32. So I think it's easy. It's as easy as that. What do you feel is going to, like, you have to, the data's already gotten you there. Now it's understanding the types. Well, actually, one thing is understanding the type of property there as well. I was actually just having a conversation with a friend of mine that it's actually in WA. There's a suburb in WA that looks really good. The challenge with it is they changed the zoning for it, and they now allow triplexes everywhere. And they have absolutely destroyed the value of this suburb. So even if you want to buy a property in this area, there are so many triplexes that your property could be a triplex, but it's actually not worth.
Is it a triplex or a triplex show? I thought it was a triplex, but probably could be triplex. I don't know.
Oh yeah, never thought about that.
Yeah, could be English.
Awesome. Yeah, there you go.
No,
I
absolutely agree with you there because like understanding what's actually happening and speaking to like. Have we talked about sort of speaking to property managers or speaking to those sort of people as well to understand those hotspots from not spots?
100%. Yeah. And have those conversations beforehand. Look at microburbs. Where is the bad pockets on there as well? Speak to property managers, speak to local professionals, but you can't outsource your responsibility because at the end of the day, the property manager wants to get a listing. So they're going to try and get you as much as possible. So you just have to make sure that where you're going, like that's my biggest thing. Everywhere, every place that I buy in, no matter what, I would have flown there and been boots on the ground in that area and ruled out the areas that I'm not buying in. This is a great question. If the suburb itself is built out, but the neighbouring suburb is not, is there still a supply threat? Rockingham, the suburb which is built out, that sits next to East Rockingham, heaps of vacant land. What do you reckon of that, Jeff?
If the suburb itself is built, let's say Rockingham, because this is what, because I did research on Rockingham when I did calling up, because there was Baldivis, which is kind of close to, it's in that sort of vicinity. I would be, what if the suburb's built out? but not the neighbour suburb. Is there still a supply threat? Yes and no. I'm going to sit on the fence there. I would say it. Well, because it's not in that situation. Yeah, it kind of you need to understand how many people are actually moving to an area, because if there's not a lot of people moving to an area, then yes, that is a threat. But so you need to understand it's not, you can't just consider these things in isolation, because if you start saying, oh well, it's not a threat, but then why is it not a threat? Because it's not a threat because a lot of people are moving. It's like up in kind of Logan, like parts of Logan, you've got like I think Springfield Lake's up there, like all those parts of Logan, and they're building all those communities, and yes, a lot of people are moving to that area, but how much land is available? So it comes down to, it's hard to give. Yeah, it is a threat if there isn't that many people moving to an area. So how do you actually know that? You look at population projections, and you need to sort of then understand and sort of have a reasonable understanding of what potentially could come through the pipeline. So you can't ever 100% predict it, but you can sort of understand. What are your thoughts, Joe?
Yeah, I think it really depends on the area and the location itself, because what you'll see is different areas on the map may look different areas may look like you can infill. Sorry, not infill. You can just build heaps of areas, but there may be a river that runs through it, or some kind of physical boundary, like a massive road. So you just like what we said on that Palm View one, there are two sides to that suburb. That suburb one has the really expensive stuff and has all the cheap crap. If I was to buy, I would be buying in the nice suburb over on the left hand side. I guess what they're saying is, if there's a built-up dense suburb here, should I buy in here if there is supply risk over on the other side of the road? So the answer is it depends. I don't like to buy in suburbs that allow a massive supply to come, but it can be done as well. So if there's some kind of physical boundary, like you were just talking about Logan, actually, Jef, like a good example.
Let's bring it up. So let's start to throw your questions in, people, because we're going to wrap this up sort of pretty soon, but we will sort of stay back and answer as many questions as we can. Can't guarantee they'll be.
Yeah. So like an example here is Boronia Heights, right? Boronia Heights is a pretty nice suburb in Logan. I've driven through all of Boronia Heights. I like the suburb myself, but there's a lot of, like, around it is a lot of potential supply risk, and you can see that right here. But does that mean you shouldn't buy in Boronia Heights? Because you can't build in Boronia Heights anymore. So it's already kind of self-contained with no extra supply to come to it. What is going to happen is these, little McMansions that they've got along here, they'll start to get built out. But as these areas get built out, the Boronia Heights people may benefit from that as they build out a new Coles, a new Woolworths, a new infrastructure. So it really does all depend on it.
And Victor's asked a follow-up question, mate. He's getting plenty of value tonight. He said, would things change if the two suburbs are in different councils? I mean, potentially, probably yes, because if it depends on are we actually talking WA here, Victor? Because I don't necessarily, like, if you're talking kind of councils, I suppose, yeah, they could have, they're probably going to have different regulations.
It wouldn't affect me. Yeah, it wouldn't affect me if I wasn't thinking. If I cared about subdivision, absolutely, I'd care what suburb it is. But yeah, if there's a whole supply coming on that side of the road and it's not going to affect my suburb, then I wouldn't necessarily be too scared against it. The ideal situation would be to buy on the other side of the suburb so that these houses are not going to affect those houses. This is an interesting thing. And I want to ask the question to the person that posted it. I don't know who did it. 2022 CoreLogic results. Who?
Brendan Colwell. You know Brendan, mate. He's a regular.
Yeah.
Every week.
CoreLogic shows Baldivis is the highest sales volume by far in Greater Perth. So does that mean sales volume as in the amount of sales, like the amount of properties sold, or like growth?
Well, no, sales number. So the number of properties transacted. I
So does
imagine.
that mean that's a good growth location to buy in if it's selling the
Well,
most amount of properties?
I think what Brendan might have identified is it's a growth corridor. I mean, you've been to Baldivis, haven't you?
Ooh,
Baldivis?
yeah, I drove through it, made a joke of it because it's not a suburb to buy in.
No, no, yeah. So I think it's probably one of those growth corridors, isn't it? They've identified, which doesn't mean capital growth.
1,209. Yeah. So I went through Baldivis. I made a little video and showed the problem that you have with Baldivis is that we don't need to bring it up on the map. It's down there in Rockingham. You'll see it. On the east side, it's just constant land supply. So yeah, 1,200 sales. They'll just keep pumping them out. They'll just keep creating more and more and more. And they're just selling more and more house and land packages to people. So yeah, I wouldn't be buying in there. There's no tight supply and demand for it. Answer that.
I love it how people are just throwing numbers and stats at us throughout they're just close as Kenny at 513. But it's 1,200 sales actually. I mean, there's a few. That's what 100 a month.
A lot.
So, yeah,
That's a lot of sales.
Yeah,
100 a month.
So, have you done with boots on the ground, Joe? I feel like I sort of
did I wrap it up?
Bit.
Yeah, create a grading system, and then you can have a quantifiable, unbiased, repeatable process. And you'll be good to go. So that's my system. House and land packages, you can't lose. No, you can't lose, and you will. But again, it's like, and people that have bought house and land packages, I always say as well, like you've probably done pretty well. Like there was a comment in here, the Sydney market, every market has grown in the past 3 years. So you can still make money in it, but is it the best allocation of your resources? I don't think so, but you can still make hundreds of thousands of dollars into it. So if all you can do is get into a property for $5,000 for a low deposit and you think it's a good, like that guy that bought the land, he probably only had to put $5,000 down. So all of his cash on cash return, if he's able to work the builder's margin and like the build and keep it affordable and make money out of it, awesome. He's done a good job and he's a good property investor. Yeah. Any more questions? Chuck them in.
Any thoughts on Palmyra I'll probably butcher that name. I'm sorry for all your Perthites in Perth.
I think they're more insulted by being called Perthites, to be fair.
What do people from Perth call themselves anyway? Perths, or are they? Yeah, I'm sorry, Perth. I love you. I had a quick look at this one. Have you heard this? I've heard this. Oh, I haven't heard this place, but I had a quick look, Joe. Do you have any insights?
No, you go to it, mate. You go to it.
I mean, I literally just did a quick Google search and I saw it's out Fremantle way. So, I mean, it's quite expensive. So, I mean, my thoughts are that it appears like I know Fremantle's gentrified somewhere because Fremantle used to be, correct me if I'm wrong here, Joe. I mean, you might not know either, but if I understand, it used to be quite working class. You had the dock over that way. I imagine like the
yeah, it kind of reminds you of like the Rocks in Sydney, where it's like a dock and all of the townhouses and things are up there. Where
so that's why they're called the Fremantle Dockers. It all makes sense to me now. The AFL team. No, I mean of course it makes sense, but I think just at a very high, like the median house price in Palmyra was, it says 815, and it absolutely pumps from. I mean, when I say pumps, like
it's a nice suburb.
Yeah, nice. Like it depends on why you're buying in that area. Like, are you buying to live or as investment? Like, if you're investing that much, like, is that the best place for your money? That's like, you got a rental yield of just over 4% gross rental yield. So, I mean, I don't know. Is it going to should continue to shoot the lights out? But if you want, I mean, I don't know the suburbs, so these are just my kind of looking at the very high level numbers. So, yeah.
It's a nice suburb. Once you start getting into that $800,000, $900,000, it starts to make a little bit more sense to maybe split up the properties into two more affordable properties, just from a numbers perspective. So if you do, but it's not to say that you can't buy a high cash flow property like a commercial that is going to fund the growth for yours. So it's how do you set up your portfolio? If you don't want any headaches and you want a nice set and forget, maybe that is like good growth, like good growth fundamentals, then maybe that is a good option for you. It really depends on what your portfolio is, where you are, what your risk profile is, and what your time commitments are. How much are you going to invest in this?
Yeah.
Okay, well, maybe we should summarize what we have learned today, Jef, and then jump to any final questions and then get out of people's hair so they can enjoy their pre-Australia Day night. But what was rule one that we learn?
I said start with your budget and then your location, because the problem is if you start with the location first and your budget's only 400 and you're in sort of Sydney, Melbourne or Brisbane, you're going to struggle with 400. Like, it's not, of course you can buy for 400 in these locations. You can.
Yeah.
But is that, so that's what and then we went
100%. Yeah, I agree with that one. You need to go in with, going back to this one, start with your budget and then go to the location. Start with your budget, know how much money you've got, and then find the best place to allocate that resources. Land appreciates, buildings depreciate. That's the most important thing you can take away from this entire session. Land is where the value is. Don't go to areas that have a large gluttony supply of land. That's what you're buying. You're not buying a house. You're just buying a piece of land, and then hopefully you've got some income off of that, which is a house. Anything? Yep.
So I tend to, and then we spoke a little bit about house and land off the plan. So that was an example, an illustration of the land appreciating versus buildings depreciate. And I think you are right, because you can see it in the valuations of the land prices. Like, land is valued at more than the property, and how scarce is that land that you're looking to purchase, like that suburb? Like, can they build more of it at the drop of a hat, at a pen stroke? And if they can, then maybe there's not a lot of value in purchasing that area from an investment perspective.
Yeah, but if you can hold a property, aim for value add, right? This then folds onto this one. If you can hold a property in a good, decent location that is going to want more development, that people are like, that's how it grows, right? It starts out as a vacant blot of land, and then people start to come. Farmers are like, you know what, actually, we should put a Coles here and a Woolworths. Okay, and then more houses come, and then the builders come and say, look, I think I can get $100,000 more for if we cut this up into land, and then they put more houses and more infrastructure comes, and then it's more desirable, more population comes, and then like, oh my gosh, we've cut up all this land, we're built up as much as we can. Shit, now we need to start cutting these blocks up. Now we need to start doing 1 into 2s. Actually, we need to start thinking, we need to start putting units somewhere. Where are we going to put those units? Where is the best place for them? And then they're like, oh my gosh, there's way too many people here. Now we need to really reconfigure the way this is laid out. We're going to have to put, towers here. But if you can hold 800 square meters of land on a suburb that's going to have those type of things in 10, 20 years time, probably going to do pretty good.
Yeah. That goes in quite nicely to your location data side, location. So what did we sort of learn through the location? I think it was all about understanding the desirability, what's going on in the suburb.
Yeah. Why is that location good? What is driving the fundamental drivers? What are the fundamental drivers of demand for that area? Look through all of those. What supply of property is coming on the market, which is crucially important. It's very important to see where the supply of property is coming from, and it's pretty easy to kind of check that as well.
Yep. For any last questions you have, because you don't we don't often get times where you can ask either Joe or myself, and people message me from time to time. I'm like, I just don't always get the time to. But it's not about the number of properties, I suppose. It's about what those properties are doing for you. Is my kind of playbook number 3. I think that sort of really hits home the last sort of side of, or the reason why we invest in property is or any investment class or asset class, is to understand what it does for us in our lifestyle. What does it do for us?
What does it do for us? That's a very good question. Come up with that net cash flow number and think about, like, if you are retired and you no longer work, which you'll get to, and you'll be like, this sucks, I'm going to go do something I'm passionate about. But try and, aim for a number that is replacing your salary. And maybe you don't even need your salary because you're not going to be spending money going to and from the office. You're not going to be spending money doing all of that. So maybe you can live off $80,000. Find out, make it happen.
Yeah, make it happen. And the last one, boots on the ground. What are we?
Very important.
Yeah, vitally important. The last 20%, the Pareto, the data analysis, and then the last, so squeezing a little lemon to get that optimum result. Get boots on the ground. Understand the hotspots and the not spots, as Joe says.
Mm-hmm. Yeah. Great question coming up from Victor here. Regarding value add, if you aim for a subdividable land or rezoned location, this would risk oversupply in the future after people have subdivided. Does it mean we should sell / cash out before the area is flooded with triplexes in the future? Great question.
Have a look at. I've got an example on this. If somebody wants to, I haven't crunched numbers as to what the values, but have a look at Oxley Park, 2760 out at you may know it's up in Sydney. Do you know, Joe? Oh, it's the St. Mary's, mate. Surely you know St. Mary's.
I don't know why you have this postcode.
I may have. Oh, I know because I grew up there. That's why. That was one of the places I grew up. And my understanding is that because it comes down to what the council sort of is, because it's so development friendly. They just pretty much built townhouses throughout that sort of suburb. There was somewhat of a premium for land because it was easy to develop out in that particular area. So a developer sort of says, well, I know I can get this across the line. I'm more comfortable paying a little bit more for this type of site. So if anything, maybe it actually increases value. I mean, I don't know for sure, but I think it might.
Yeah.
Scarcity.
But it's such a great point to understanding town planning and how much the town planning is involved. Looking at the zoning maps and seeing what they've got zoned as high density and what they have low density. So in well thought out suburbs that have, things going for it, you'll see that they'll have a strip of shops, they'll have a main road, and then off of those shops will be high density, and then maybe along the coast, along the water, if there's water, might have a little bit of high density, but probably just premium. But if you see high density throughout the entire area, that's where I'd be worried about oversupply and those type of things. That's where I would be a little bit concerned. So it does come down to the council and how much zoning they've got for it. And it's a great point because it does destroy. It can destroy a suburb if it's not done correctly. If you're just constantly building out, allowing units and townhouses and all of this stuff, like people just don't want to live there, and there's no
largely just turns to people wanting to rent. I mean, I don't know the exact rental proportion of that part, but I'd say it'd be sort of 60% potentially. Like a lot of people renting rather than owning.
Yeah, cool.
David Oliver, congratulations to you as well, Dave. Well done on one of your latest purchases. Maybe we should get Dave on a live session one of these days if he's open. If he's open to it.
Open. Is he open? Check the calendar. Well, he's here every Wednesday, so in all fairness, he's not going to change anything for his schedule. Awesome session. Okay. Any final questions? Except for wonderful thanks. Thank you very much, everyone. Thanks, Victor. There we go. Amazing. Well, happy we helped out in some way.
He's open.
Open to listen to you.
That's not
a yes.
I just read the first bit. I'm open to you, legends. I
like it.
I didn't read the two.
Yeah, exactly. Well, I think that was a worthwhile session. I think hopefully people got value out of that. If you have any more questions, throw them in this channel post and we'll try and answer them. But any final words from you, Jef?
No, I just think it's I feel like it's crazy. The end of January is pretty much over. So tomorrow's 26th of January. So it's just crazy that a 12th of the year of 2023 is already done. So I just and I think, wow, what the, like, it's easy to get super busy doing kind of admin, doing day-to-day stuff. But I suppose I'd hope that people can take a bit of action and not take reckless action, but I think that's probably just the thing that hits home to me, and hopefully we're going to take some action here at Ozprop as well and just make things happen to help people out. Along with you as well, you're going to help people to buy property. What about you, Joe? What are your thoughts? What are your musings?
I thought it was a good little session. I think there's going to be some golden nuggets that people take. You never know when a golden nugget is going to drop in your lap. So yeah, time flies when you're having fun. Exactly right. Cool. Let's do it, boys and girls. Let's go buy a property. We will catch up with you next week. Have a good one.
Yeah.
Bye-bye.